So first of all, I want to know, in a broad perspective, we are attending to a V-shaped recovery, an L-shaped recovery, or we are going into a double-dip recession?
Yes, all the all the letters that have come up. We're expecting a lazy U recovery. We're looking at something that would be. We do think we're coming out of the recession. We think the recession ended last year, at the end of last year, or late last year. But we think the recovery is going to be very slow and uneven, getting out of what was the worst recession since 1946. We're looking at about a 3% growth for 2010. That's half what would normally the U.S. would see during a recovery.
And after we have seen a lot of talking about a possible double dip recession, there's some people that it's trying to get all the similarities between the Great Depression and now. Which will be the perfect storm for a double dip recession to happen right now?
Well, given being good economists, we always have to have a pessimistic scenario, and that would be our pessimistic scenario. And we put about a 20% probability that would happen. The things that would need to most likely happen was, first of all, we'd have to see a downward leg in the very fragile financial recovery that we're going through right now. So far, it looks relatively stable, but of course, the eurozone debt risk added some concerns again. Also, we'd have to see oil prices shoot up again to say something like $120 and stay up there for some time. That would be another hit for the economy. It would certainly put us at 2011 into another recession.
And let's talk just a moment for the oil prices. How do you see the West Texas price for the medium term right now, more or less?
We're still holding at oil prices to be about $80 through most of this year, and we do think it's going to come down a bit. Of course, supply disruptions are a big factor, largely from the Mideast. Certainly, the Gulf of Mexico problems would be one factor, but that's not a big supply for our U.S. markets. So largely, we'd look at some kind of supply concerns in the Mideast, particularly from the geopolitical risk situation.
And also, we were talking about Europe. We have heard before Chairman of the Fed, Ben Bernanke, saying that the U.S. wasn't going to be affected by all the situation going on in Europe. But now some people will also start talking that, well, maybe that's not going to happen, and the U.S. is going to take a hit in the medium-long term. What do you think about it?
Well, right now we think that the U.S. is not going to agree with Bernanke. He's a pretty smart guy, so we usually agree with him. But one of the factors, of course, would be exports. Export hit from to the U.S. We expect that will be a factor. We don't think it's going to be that big. We first of all think that the eurozone doesn't. We don't expect to export that much to the eurozone, relatively speaking, in our $14 trillion economy. We do think that the weak euro relative to the strong dollar now would certainly be a weight on our exports going abroad. In terms of the contagion effect that people are talking about, we can't rule that out right now. We don't see that as a big factor. We certainly wonder what's going to happen with the banks. And just a little over a year ago, we saw global financial markets collapse, and we can't rule that out.
And I know that you don't cover these kind of economies, but what's your impression about all these south countries of Europe, like Spain, for example, Portugal, Italy? How do you see them for the medium term, especially?
Well, we've already seen Greece going through certainly a major crisis, and the concern is it going to spread to its neighbors. In terms of what's happening with, for example, Spain and the UK, we think they're fighting not just risk in terms of holding whatever debt that they could be holding from Greece, but they also are going through their own housing crisis, and they may even be farther behind in terms of getting out through the recovery than the U.S. That could be a weight on those countries. We think the northern region will hold up relatively well. In fact, they're getting a boost from a weak euro, and the weak euro will also help some of the southern neighbors, particularly Italy.
And also, we are having some problems about sovereign. Well, we have the sovereign debt problems in Europe, but here in the U.S., we have seen a lot of states going through really bad times. For example, California or Illinois. How do you see them also like dealing with this situation?
Well, one of the things that the U.S. has going for it relative to the eurozone is that the U.S. doesn't need to have a vote among all the parliaments to get something through. The federal government will, in a sense, loan or subsidize what's happening with California or in other states, and which is exactly what they're doing. That doesn't make it that much. It still doesn't make it that easy for those states, and that will be a weight on that region, and will certainly push up the already $1 trillion deficit that the U.S. is holding. That's going to weigh on medium term. That's going to weigh on interest rates going forward.
Mm-hmm. And do you see any kind of a stimulus or something to help these states?
The concern there is that we pretty much have a relatively gridlocked government. We have the Obama administration has already pushed through some of the financial regulatory reforms and also put through the healthcare bill, and they don't have a lot more. They don't have a lot of political points to go through, and we do have $1 trillion deficit, and there could be a real pushback to getting any kind of stimulus package going forward.
And when we start talking about the double dip recession, it was because China seems to be losing some steam. How is this data going to affect the U.S.? Are we going to see a real slowdown in the U.S. recovery because of China?
Well, it's funny that when we talk about China losing steam, when we've just seen the U.S. go, and Europe and many other parts of the world going through the worst recession since World War II, and seeing hard contraction in GDP growth and modest growth this year. So China, they're losing steam. We're looking at something close to high single digits. Certainly, that will be a weight on their neighbors, be some weight, but they're still relatively robust. Will they slow down? Most likely so. The impact on the U.S. Well, we're actually importers of their products rather than exporters to their countries. I think the hit on China, or the slowdown in China, will certainly hit its regional neighbors, and that will certainly be somewhat of an impact on the U.S., but relatively small.
And how the strengthening of the yuan it's gonna affect the U.S. economy in the import side?
Well, that would certainly be a little bit of a cost on the U.S. in terms of imports. That would also actually reduce or slow down our trade gap. Our trade gap, while it has shrunk somewhat, it still needs further to go. And having the kind of the imbalances that we have both with the Treasury deficit and with the trade deficit puts likely risk on seeing higher interest rates in the U.S. going forward, and that long term will slow us down.
And so let's take a look to the upside side of the U.S. economy. It's a private investing picking up, because we're going to depend on that after all the stimulus are done.
Certainly, that remains of concern. That's why, in a sense, we do have this risk of something another contraction in the U.S. Though we have seen some signs of improvement. That's going to be 5, 6, 7 years down the road.